American multinational software as a service companies manage differences between US GAAP ASC 606 and Chinese accounting standards CAS 14 by relying on the shared global 5-step revenue recognition model. Because both frameworks focus on when a customer gains control of a service, multinationals align their policies but adapt to subtle local quirks regarding contract modifications, variable pricing, and disclosures. Navigating these differences requires specific strategic approaches for financial operations. First of all, both US ASC 606 and Chinese CAS 14 utilize the same 5-step process for recognizing revenues. Number 1, identify the contract with a customer. Number 2, identify distinct performance obligations. Example, software access, implementation, and premium support. Number 3, determine the transaction price. Number 4, allocate the price to each distinct promise or performance obligations. Number 5, recognize revenue as those promises are fulfilled. Because both standards require revenue to be recognized as services are delivered rather than when cash is received, American SaaS companies operating in China can use largely unified global billing and revenue operations softwares. Salesforce Revenue Cloud, Stripe, and Billing Platform, for example. But here are the subtle differences. Despite sharing the same broad framework, minor nuances exist that force multinationals to make localized GAAP adjustments. Variable considerations. ASC 606 requires companies to estimate variable fees, like usage-based overages or volume discounts, early and include them in the transaction price if it is probable a reversal will not occur. However, CAS 14 takes a slightly more conservative approach, demanding closer scrutiny on contract enforceability and probability thresholds. Contract modifications. Adjusting an active subscription can trigger different treatment. Under US GAAP, changes are often viewed as a separate contract or cumulative catch-up adjustment depending on the nature of the software update. Yet, CAS 14 may apply distinct timing rules for how these adjustments hit the income statement. Example, if an HR software subscription adds a premium module, US GAAP may treat this as a separate contract or cumulative catch-up adjustments. On the other hand, CAS 14 may require recognizing the modification's revenue systemically over the remaining performing period, creating a distinct impact on income statement timing. Fulfillment costs. Under US GAAP rules, companies often capitalize specific sales commissions and amortize them over the life of the customer contract. Still, CAS 14 has historically taken a tighter stance on which these costs can be deferred, impacting operating margins reporting for Chinese subsidiaries. Now, here are how multinationals address these differences. To prevent dual entry accounting chaos and simplify consolidations, US SaaS companies do 3 things. Number 1, global standardization of contracts. Organizations draft universal service level agreements to ensure standard global pricing and contract terms. These minimize the gap between US contracts and Chinese localizations. Automated revenue subledgers. Leading tech companies decouple billing from revenue recognition by utilizing dynamic revenue subledgers. These platforms can natively calculate both ASC 606 and CAS 14 schedules, automatically generating the necessary reporting data for corporate consolidations. And centralized review teams. Instead of handling the differences completely in-house locally, regional finance teams in China work in tandem with US-based technical accounting experts to map out and document local GAAP adjustments for corporate reporting quarterly. Overall, navigating US GAAP, ASC 606, and Chinese accounting standards CAS 14 requires aligning policies around a shared 5-step revenue recognition model while utilizing automated systems to handle subtle local nuances. By implementing standardized contracts, automated revenue subledgers, and centralized review teams, US SaaS companies can effectively bridge the reporting gap and ensure compliant consolidation. Thanks.